Hey guys, how you doing? In this video, we're going to talk about the things you need to know when buying a home. But before we get started with that, let's cover some administrative stuff. First of all, guys, if you are looking to buy or sell a home, we'd love the opportunity to talk with you. You can see my number pop up somewhere on the screen here, guys. Please give us a call. Love to talk with you. Also, if you're somebody who keeps track of the real estate environment, look around the screen here, click on a subscribe button. Finally, love to hear from you. Comment below, guys. Let us know how we're doing, and let us know if you have any questions. You know, again, in this video, guys, we're talking about the things you need to know when going into buying a home. Now, we're going to cover some terms within there, and we're going to give you kind of the back end story behind each one of the terms. And the idea behind this is that you get enough information that you can have really good conversations with your mortgage loan officer. You can have really good conversations with your realtor when going in and getting ready to buy a home. Also, you'll understand, you know, when they're calling up and talking some of the lending jargon and so forth, you'll have an understanding and be able to keep up and get as much information as you can out of those conversations with your realtor and mortgage loan officer, okay? I got it. So the first thing we're going to get into is talking about a mortgage. And most of us know that a mortgage is the loan that you use when buying a home. What we don't know is there's so many different types of mortgages out there, guys. There's adjustable rate mortgages where the rates can change, fixed rate mortgages where it's locked for the life of the loan. You've got mortgages where it starts out as a fixed rate and then it converts into an adjustable rate. You've got different terms. You've got 15-year, 30-year, you know, and the most common we're going to be dealing with are 30-year mortgages, okay? And that's what's used in most cases when buying a home. And that's what we see in most cases. And what that really means, it's a 30-year mortgage, okay? A 30-year fixed rate mortgage. So the rate is actually locked for a 30-year period of time. And the monthly payments are locked as well. And those monthly payments are set so that they will pay off your mortgage within 360 months or 30 years, okay? And so that's a 30-year fixed rate mortgage. Now, there are four types of loans that we see most commonly, which is conventional financing, jumbo financing, FHA financing, and VA financing. And that's the most common that we see. Conventional financing means in the East Bay, this is loans that are below $1,149,825. So loans within that category, there's some real advantage to it. It's the most popular loans that we see, but there's some categories to it. Number one, your down payment can be as little as 3%. So that's a real advantage. In most cases, your down payment is 5%. And you know, you're going to get really attractive interest rates and so forth. Your closing cost is going to be at a minimal and things when looking at conventional financing. The other side of it is jumbo financing. So this is jumbo financing are loans that go above that conventional financing limit. Now, because these loans are larger, also because the lenders portfolio these loans are, they hold on to them. They don't sell them on the secondary market like the conventional loans. They hold on to it. The rates are typically much higher. The underwriting criterias or the credit is much stricter for these type loans, okay? So you've got conventional, you've got jumbo. Jumbo, again, goes over that $1,149,000. Another thing about jumbo, sometimes because the rates are so much higher and it's so much, the credit criteria are so much higher, we do things to avoid them. So we'll sometimes do a conventional financing, and we'll do some type of other second financing and then a down payment to really kind of keep you out of that world of jumbo when buying a home. Okay, so that's, again, conventional jumbo. The other loan we'll see a lot of is FHA. Now, one of the big things people think is FHA is for first-time home buyers. That is not the case. Anybody can get FHA financing. The real benefit to FHA financing, it's government-backed, so the government guarantees a certain portion of it. And what ends up happening is your down payment is a lot less, so it only requires 3.5% down. Your if you've got credit concerns in the past and so forth, credit requirements are eased a little bit with FHA financing. And the other thing is your debt to income ratio are a little higher, so you can come in with less income and still qualify with FHA financing. So again, that's conventional, jumbo, and FHA. The final loan we see pretty common, again, at 30-year fixed mortgage, is the VA loan. VA loan is strictly for veterans and their spouse. So it's veterans and active duty members and their spouse. They can buy homes. Now, the big advantage is 100% financing, so you don't have to have any type of down payment. The second thing that's really good about VA financing is that your debt to income ratio can be significantly higher with VA mortgages, okay? Okay, guys, so we were just talking about mortgages. Now let's get into the mortgage loan officer, MLO, mortgage loan officer. Now, one of the things, that is the common name that's given by the industry, and government agency, regulatory agency, is mortgage loan officers, to identify those folks that are the front-facing representative of the lending organizations that you're working with, the banks and so forth. Now, mortgage loan officers, you look at their business cards, they're going to have all sorts of titles. You know, it's senior mortgage consultant, senior mortgage advisor, and so forth. But what the industry calls them is mortgage loan officers. Now, here's the really kind of the key idea behind this. These are not the folks that are making the credit decision. These guys are your advisors. They are your partners. They're your advocates within the lending organization. They're going to help you analyze your credit situation, come up with the right product for you, and be your advocate within the lending organization. They're going to help you create that perfect application, get you approved for whatever product that's best for you. So they're your advisor and your partner within this organization. So one of the ways to really find a great MLO or mortgage loan officer is number one, experience. Guys, the more loans a mortgage loan officer see, the better they're going to be. The more they know about credit, the more they know of hurdles they're going to run into and how to get over those hurdles. Also, activity. An active loan officer, somebody who's doing a lot of loans or seeing a lot of loans, are going to know all the answers, are going to know a lot of the answers up front. Now, one of the quick ways to really kind of figure out your mortgage loan officers, most of these guys have got a lot of information on the internet. So Google the name, Google the names of their company, look at what the reviews are and stuff. And that's a really good way of getting some insight regarding the organization that you're working with, the lending organization, also the mortgage loan officer you're working with. In the process, if you're not feeling that they are your partner, they're your advocate within the lending organization, they're somebody you can trust to have open and honest conversations with, and they have the knowledge that you need to be comfortable with to really help you get approved within the process. You know, one of the things you want to do is kind of maybe step away and reevaluate. Got to tell you, one of the most important steps within the buying process is that mortgage loan officer is known as somebody who can get things done. Because when you're making an offer, the agent and the seller are also analyzing that mortgage loan officer. They're analyzing that realtor to make the decision, hey, is this a person that can get it done on the other side? Because they don't want to pull their listing off the market, and you got a mortgage loan officer that can't actually push the loan through and things, okay? The next step, again, we've talked about mortgages, we've talked about mortgage loan officers. You're going to hear all the time, underwriting. Underwriting is that back-end process that happens once the loan leaves your mortgage loan officer. Now, underwriting or underwriter is very specific, but there's a whole group of people in the back end, and you'll hear them being referred to as underwriting in the back. But there's underwriting, there's there's a processor, there's an appraisal desk, there's a funder, a closer, that's involved with the process. So, there's going to be a lot of things that's going on back there. Underwriting is that specific piece where they're making a credit decision. They're they're analyzing your financial situation. They're looking at how it meets the lending organization, the bank, or so forth. Underwriting criteria. In a lot of cases, they're just entering information into systems that spit out an approval and so forth. But But in a lot of cases, the underwriters are interpreting the information and things like that that's sent to them. So that's a key component. So when you hear underwriting, they're really talking about that back end process. But in a lot of cases, they're talking about that credit approval piece of it. Now, underwriting is going to credit approve you, and they're going to conditionally approve you. They're going to approve you on certain conditions. One of those conditions is that you have an acceptable appraisal, that title can close and we can fund. Those are conditions that are going to be in there. Sometimes, you know, it'll be conditions that you have you know, some additional information and things like that to provide to them. Okay, so again, just you'll hear the term underwriting quite a bit. Just want to make sure you know what that is. Okay, now the next component, and one of the things you're going to hear quite a bit, is debt to income ratio, DTI. So and debt servicing. So those are two words, those are two different things, but debt to income ratio is a ratio that the underwriter, which we just spoke about, is actually going to generate. And it is a comparison of your, as just as it says, your debt, your monthly debt to your income, okay? So how are they going to calculate this? So let's give you a scenario, okay? They're going to take on a monthly basis what your loan payments are. Let's say you've got a credit card that you pay $200 a month on, okay? You've got a car loan that you pay $400 a month on. That's $600 a month now that you're paying. Then you've got a student loan that you pay another $200 on. That's $800. And you got a personal loan that you pay $200 on. So that's $1,000 per month that you're paying right now out to lenders. So now let's say you're applying for a loan and you're getting a pre-approval, and that loan that you're applying for is let's say that loan is $1,500 per month is your monthly payments. Now, so with that $1,000, you already owe $1,500. So your monthly income, your monthly debt now is $2,500 per month. Your income, let's say it's $60,000 a year or $5,000 a month. Now that's your gross income. So that's before deduction and things. So you're going to divide the debt, which is $2,500. The original $1,000 you have plus the new mortgage that you're getting for $1,500, and you're going to divide that by your income, which your income is $5,000. So you get 0.5, you move the decimal over and you get a percentage, so it's 50% is your debt to income ratio, okay? And so that's one of the things you're going to hear quite a bit. I mentioned the term debt servicing. What we actually did earlier was debt serviced. We look at your loan, we looked at your credit card, we looked at your auto loan. So these are the items that are being debt serviced. These are the payments that are actually being used to come up with your debt number. So that's called debt servicing. So those are two terms you're going to hear quite a bit when going through the loan process or the pre-approval process for your loan. Another piece of it, and you're going to hear this in relations to down payment, is LTV, or loan to value. And that's exactly what it says, loan to value. Let's say you have a house, okay? You own a house right now and it's worth $100,000, okay? And you have a loan of $50,000, okay? So you divide that $50,000 by the value of your home, you come up with 0.5 or 50%. So your loan to value is 50%. Now, where you're going to hear this most is with regards to your down payment, okay? So when you make a down payment, let's say you're buying a home for $100,000, you make a $20,000 down payment, or 20%. This means that your debt that you owe, the mortgage on this home is $80,000 or 80% of the home, okay? So that means your loan to value is 80%. Now, where this comes into play, and we'll learn about it a little bit more down the road, because in this video, I'm also going to talk about mortgage insurance, and we're going to kind of touch on debt to income. That's going to be, or excuse me, a loan to value. That's going to be an important component of it. But one of the things we're going to see is interest rates. When coming in and making your down payment, which is the cash you're going to come out of pocket to buy your home, the more of a down payment you make, the better an interest rate you're going to get. Typically, you want to have a 30% or more, where your loan is 70%, or you have a 70% loan to value, to really get a benefit with your with your interest rates. So we actually spoke about just now loan to value. The next thing we want to get into is mortgage insurance. You're going to hear about this quite a bit. You're going to hear it's called MI mortgage insurance or PMI private mortgage insurance. So you're going to hear that quite a bit. Basically what that is, it's insurance that's intended to cover the lender if you default on the loan and that lender takes a loss, okay? It also repays the government agency that's backing the loan, okay? So it covers any type of loss if you got PMI. Now, not in all situations do you end up having to have PMI. With conventional financing, where you end up having to have PMI is if you're putting in less than 20% down. So if your loan to value is more than 80%, with conventional financing, then you're gonna have to pay PMI. Now, one of the advantages to PMI with conventional financing, it's actually not that expensive, okay? It's really driven by credit score and so forth and what your debt to income ratio, your loan to value actually is. So PMI, it can be also, it can be fairly inexpensive with conventional financing. Also, the other thing with conventional financing, it is, after a certain amount of period of time, it goes away. Also, as your home prices go up, you can actually go out and get an appraisal done and send it to your lender and get PMI removed. So it's something you can get rid of pretty quickly, okay? And also you can refinance and get rid of it. Now, the other loan that actually ends up with PMI is FHA. FHA PMI is required. It doesn't matter how much your down payment is. It doesn't matter the length of time you stay in the loan. The only way to get out of PMI with FHA financing is to refinance into conventional financing. Finally, the loan we spoke about is VA. VA, you come in with 100%, there's no PMI. So with no down payment, you have 100% loan to value, you have no PMI. Matter of fact, one of the things that happens with VA loan, and this is one of the benefits to VA loans, is that your down payment your closing costs can actually be financed by FHA financing, and you can actually be over 100% and when you roll in your closing costs. And it doesn't have any PMI on it or any private mortgage insurance or mortgage insurance, okay? Our next thing that we'll talk about is P.I.T.I, or principal, interest, taxes, and insurance, and principal and interest, or P.I. So basically, I just said it, P.I.T.I, you'll hear it referred to, your lender is going to talk about that, your Realtor may talk about it, and it really means principal, interest, taxes, and insurance. Now, principal is the amount of money that you owe on the home. Interest is the amount that you pay the bank on a monthly basis. So when you have P&I payments or principal and interest payments, that's your monthly payment that you pay for the bank. Now, when we start talking P.I.T.I, T is taxes. It's not your income tax, it's property taxes. And they're rolling that in there to debt service. We talked about the debt to income ratio. That actually becomes part of it as well when we start talking your debt to income ratio is the amount of taxes. And also insurance. The insurance, normally it's just your hazard insurance, but if you got PMI in there or mortgage insurance, you can also, that's also going to be rolled into the P.I.T.I, okay? So P.I.T.I is just your monthly obligation, your monthly payment. So principal, interest, taxes, and insurance. All right, guys, the next thing we want to cover is impound accounts, also called escrows. Now, impound accounts is a situation where you actually pay your lending organization or the organization that does the loan for you or services the loan. You're actually paying them for your property taxes and insurance. Now, there's a couple situations that this pop up. If you got conventional financing and you don't put a full 20% down, you're going to end up with P.I.T. You're going to end up with impound accounts or escrow accounts. And also with FHA financing, you always have to have impounds with FHA financing. So again, one of the things that's going to happen is your property taxes and your insurance is collected with your monthly payments and paid. Now, one of the things you're going to see with impound accounts, because it's being paid, when your lender is going to collect from closing costs upfront, when you do the loan, they're going to collect a certain amount up front. So they may collect maybe 2 months to 6 months worth of monthly impound payments up front. So consequently, in this situation, your closing cost is going to be a little bit more, okay? One of the things you heard me talk about, and this is refinancing. That's another term you're going to hear. When you get into the mortgage world, you get into the real estate world, you always hear the term refinance, and a lot of people know what this means. It simply is just getting a new loan. You're going to get a new loan for a couple reasons, okay? You're going to get lower interest rates, reduce your payments, okay? You may get cash out from your loan. Cash out really means that you're getting money personally from the loan. So you get a higher loan and some of that money comes to you personally. You can use that money to pay off debt or whatever, okay? Also, sometimes to go to a shorter term. You may have a 30-year mortgage you've paid off for a while, and now you can refinance to a 15-year. And what that does is gets you a lower interest rate, and the payment may actually be the same, so you can pay it off much sooner. Guys, the next thing we want to talk about, something that you're going to hear quite a bit, is credit score. You guys, everybody probably knows what this is. Again, guys, credit score is going to come up because this is kind of the grade on your credit. It can impact the loan product you get. It can impact your interest rates. So it plays a key role in the credit decision, something that the underwriters are looking at. Now, your mortgage loan officer, your MLO, will pull your credit score as long as you have approved it and it's up front there. And they can help you out. Instead of having to go to credit repair agencies, if there's any concerns and things, they'll work with you, and they have systems that allows them that tells them things that they can do to help you improve your credit score. So a great mortgage loan officer is going to have that. What ends up happening is you get mortgage loan officer is going to pull 3 credit scores from each of the credit reporting agencies. They're going to typically use that middle score. Now, if you got multiple borrowers on there, they're going to use the middle score of the lowest person, or the person with the lowest credit. Typically, conventional financing, we're looking at about a 640 credit score and better. We can go as low as about 580 credit score with FHA financing, but again, your interest rates may be higher and so forth if we're going down to those lower credit scores. One of the things you're going to see is a couple of things. You may see different credit scores from different organizations and things. You have a bunch of credit scores. You have a credit scores for buying auto. You got a credit scores for credit card, because they all act a little bit differently, and there's different ways that they create losses and things. So these credit scores vary from all over the place. So you're going to see multiple credit scores. Also, one of the myths out there in mortgage lending world is that if you work with multiple mortgage advisors and you have a credit pulled multiple times, it's going to impact your credit score. That is not the case, guys. One of the things that's going to happen is the system is set up to allow you to shop certain credit products, and that includes mortgages. If you have multiple inquiries within a 30-day period of time, they only count as one inquiry, so that they're not going to have any type of big impact on your credit score. Okay, guys, so the other thing we want to talk about now is closing costs. So we've gone through and talked about a whole bunch of stuff, and you've heard me say this quite a bit, is closing costs. And what closing cost really is the out-of-pocket expenses you pay for services related to buying your home, and also services that come from your lender, okay? So those are your closing costs. These are out-of-pocket expenses. They typically cannot be financed, so it's part of the cash you want to consider to have. One of the numbers I always tell people to cover their minimum down payment, to cover their closing costs, and cover moving expenses. Think about the magic number I was talking about, 7%. You're buying a home for $100,000, you want $7,000. If it's $200,000, you want $14,000. That covers your down payment, closing costs, and moving expenses. If it's $500,000, it's $35,000, and that 7% is kind of a number that we want to look at and things in there. There's a bunch of different things that roll into your closing costs. It includes property taxes and so forth that needs to be paid at closing. You know, any type of fees related to an HOA or anything like that. Fees related to the processing in between, which is your escrow company, your title and so forth, all falls within there. Your lender will have some administrative fees and so forth that falls within there, okay? The next thing we're talking about is down payment. We mentioned it earlier. Again, this is the cash out of your pocket that you're putting down when buying a home. Remember when we were talking about loan to value or LTV, we were talking about putting 20% down. If it's a $100,000 home that you're buying, you're putting 20% down. You're basically just putting $20,000 down with that. In the buying process, another terms that you're going to hear that are really important to you is title and escrow. Title and escrow, you're going to find that they're used interchangeably. People will say title when they're really referring to escrow, and vice versa. In most cases, you'll hear them referring to title because typically the companies that take care of escrow are title companies. So, you know, it's Old Republic Title, it's Stewart Title, it's Fidelity National Title, and that's what you hear. But title is not escrow. They are two different things. Title is actually insurance. It is insurance that you buy to protect yourself and also protect the lender for any type of unforeseen liens against a home that may arise at a later time and so forth. So they do a prelim. It's a title search to make sure that it's clear of any type of liens, but there may be some type of unforeseen liens. If your home was built in 1959, there may have been in 1965 some type of lawsuit and there should have been a lien applied to the home and so forth. Never was. And now somebody has determined that and they're coming back and going, hey, this lien should have been done in 1965. Now you owe me this. You know, so title insurance will step in and protect you at that point in time. And that's what title insurance is. And again, they protect the lender. Escrow is that middle processing between yourself, the buyer, and the lender. Now, you know, picture this situation. You know, if you were dealing directly with the lender, you would tell if you're dealing directly with the seller, you know, you tell the seller, well, I'll give you the money once you record. And the seller's going, no, you give me the money, then I'll record, you know. So we have this third party that sits in the middle. All the money goes to them. This is the escrow. And once all the legal obligations are met for purchasing the home, they're actually going to work with the buyer. They're going to have them sign documents and so forth, and is going to record on title. Once it records on title, all the money is gathered here within escrow. Even the seller's fund, even the lender's funds are emailed to, are wired, not emailed, wired to escrow, and the funds sit there. And once the transaction is recorded, then all those funds go to the seller. Okay, so that's title and escrow. It's that intermediate. It's the in the middle process. Again, you know, two terms that's used interchangeably, but again, title, remember, that's insurance and things. Okay. Okay, guys, so we were just talking about title and escrow. Another important part of escrow is your deposit or earnest money deposit. Now, one thing's going to happen when you make an offer and your offer gets accepted. One of the first things you got to do is put a deposit into escrow. Now, this deposit is not a payment for anything and so forth. It's eventually going to become part, once we close, it's going to be part of your down payment, or it's going to cover your closing costs. So that money's not going away or anything like that. So that's what we're referring to, earnest money deposit, or EMD, or simply deposit. Now, one of the things you got to be aware of with the earnest money deposit, it also becomes subject to liquid damages. Now, what liquid damages means is that you've actually done something that backed out of the transaction in such a way it's caused some type of damage to the seller. And now there becomes a situation that you may lose that money, or the seller may be able to hold on to that money to cover themselves for cover those damages that they've experienced, okay? All right, guys, so next thing we really want to talk about is inspections. Now, one of the things that people, a misunderstanding people have is they hear inspector and they think, well, it's a building inspector coming out to see if, you know, it's complying with building code and so forth, the home we're buying. And that's actually not the situation. These are private companies or private individuals who are either licensed or certified to do these inspections. Now, the inspections can be provided by the seller or provided by the buyers, and both both ends, there's some real advantages to doing your own inspections. Guys, one of the things on the seller side, it ensures you don't have any surprises. It puts you in a better situation for negotiating and things, and for the buyer, it ensures that you have your inspector taking a look, somebody who you're paying for and somebody who's on your side. Sometimes, an inspector that comes out, you don't know who that inspector is that the seller's hired and so forth. You want to make sure you have your quality inspectors. Again, these guys licensed and certified private companies. They're going to come out and do the inspections. Now, one of the big advantages to an inspector is they will have a systematic process to analyze each part of the home. For instance, if you just bring out a contractor to walk through in the home and so forth, contractor is not necessarily used to going through and looking at homes like that, so they don't necessarily have that systematic process. So they're going to walk around, they're going to look around and see different things. And a lot of times that contractor's feedback is going to be based on their opinion of the quality of work and their opinion of the material that's being used. They're not necessarily going to go on and run your dishwasher, see what condition that's in, flush the toilet, see if your toilets are loose and that kind of thing. They're not going to have that systematic approach. Now, inspectors range from property inspectors who's involved in the overall analysis of the homes. Pest inspectors here in California, pest inspectors are typically looking for termites and dry rot. You're going to have roof inspectors. You're going to have sewer inspectors, foundation inspectors. We've got drainage inspectors, mold and fungus inspections, so it goes on and on. So there's a bunch of different types of inspections. One of the things is, guys, work with your realtors, figure out the type of inspections you need based on the age of the home, based on the location. Some inspections are required by cities and lending. Some of the loans require certain type of inspections. So make sure you work with your realtor to figure out what inspections you need, okay? The next thing we're going to talk about is appraisals. Now, we just got finished with inspections. The appraisals are going to be required if you're getting a loan on your home. They're going to require appraisal. Conventional, FHA, VA financing are all going to require appraisals. Now, one of the things with the appraisals is that they're really looking at coming up with an estimated value for your home to make sure that the loan's not $1 million and the home's only worth $100,000. You want to make sure that the lender is going to want to make sure that that asset or that home's got enough value where they can recover their money in the future. Also, in some cases, like for instance, FHA and VA financing, there's a health and safety component to it. And the appraisals are trained a little bit more, and they look to make sure that the home is going to be suitable for families moving in there. Another component of it, when we start talking conventional finance, a little looser, but the appraiser does look to make sure the asset is something that they could perfect the lien on, and if they do need to take the asset in the future, there's a default on loan and so forth, it's going to be a quality asset that they're going to be able to resell and things like that. So it can't be totally run down and things like that. There still has to be a good quality asset that's there for them to secure a loan against. Okay. Guys, the next step is really contingencies, okay? You're going to hear that term quite a bit coming from your realtor. It's going to be inspection contingency, loan contingency, appraisal contingencies, and so forth. And what these are really agreements within your purchase contract that the close of the purchase contract or finalizing the purchase contract is hinged on. So these are agreements within there that have to be completed. For instance, there's a contingency that you're going to appraise at a certain level. If you don't appraise at that certain level, then you as the buyer can actually back out of the transaction or renegotiate the transaction depending on how that contingency is written. You're also going to have a time period. So, your realtor may work with you to set up like a 10-day or 15-day contingency. Okay, so within 10 days, you either need to cancel or remove that contingency so the transaction can move on. Again, you may have a loan contingency. So the contract, the closes contract is dependent on you getting a loan or qualifying for the loan. And if you don't qualify for that loan, you're able to back out of the transaction without any type of penalty and things like that. So that's what we're really referring to with contingencies. So guys, hey, let's Again, if you guys have any questions or things regarding anything we've covered in there, please leave it below in the comment. Love to hear from you. If you guys are buying or selling a home, guys, my number is going to be somewhere on the screen here. Please reach out. Love the opportunity to talk to you. And finally, again, guys, look around the screen. If you're somebody who keeps up on the real estate market, hit that subscribe button and join our channel here, guys. Thank you so much for your time. Okay, take care. Bye-bye.